Nolan, good to see you. I'm glad we have a chance to talk today because people are feeling a little uneasy. We're going to talk recession-proof investing, for strategies for navigating this volatility. We've been hearing a lot of scary headlines lately. What's going on?
Well, thanks, Erin, for asking. And I think that's what's on everybody's mind. What's
Yeah.
going on? It kind of seems like depending on the news station or newspaper or social media feed you see, there's different things across all fronts. Most notably, I think that we have tariff conversations reintroduced, which we haven't heard about in 5 or 10 years. Really since 2018 was the last time that was really in focus. And then, of course, we have like a potential market correction that's in the midst of being underway. And what we'll look at here on the screen is really the S&P 500. So this gives you a broad representation of what presides in the biggest 500 companies in the US. But what I like about this chart is it gives size representations for how big some of these companies are versus some of the other ones. So companies like Microsoft, Nvidia, Apple, Amazon, like the big red boxes that you see up on that screen over the past 1 month, they've been the prevailing reason that most of the market's gone down. If you look at all the other categories and all those little tiny boxes, it's a pretty healthy mix of reds and greens, whereas it's really the top 7 to 10, maybe 15 individual stock positions right now that are really causing a lot of the correction.
Yeah, that makes sense when you see it like that. So let's talk through some questions, some strategies. The first one is a question. A lot of people assume that cash is king during recessions. Are you recommending people allocate a larger portion of their portfolio to cash right now?
It can make sense for some folks. Right now, we are allocating a little bit more cash for people who have immediate cash needs. Like if you have something that you're expecting to buy over the next 6 to 12 months, now may not be the most appropriate time to be taking all of that risk with that money. So we've been, portioning cash aside for things like that. But, now and recessionary times are good times to look at commodities like gold or other stable assets too. Cash is king. Gold can be an option there too, but some more stable investments during times of increased volatility so that you can rely more on your plan and not panic so much.
And how about defensive stocks? We still get sick, we still need to eat. So these are the healthcare, utilities. What are your thoughts on those?
I like them. These are stocks that usually are relatively recession proof, and I'll always say that with some quotes around recession proof. There's not really anything totally insulated, but like utility companies, energy companies, healthcare, and consumer staples, these are sectors that you can go invest into during times of market uncertainty if you're looking for more stability, and that's really what you're looking for with those types of stocks.
And what are your thoughts on dividend stocks or other fixed income investments like bonds?
Those become better the longer you can hold on to them. I think dividend paying stocks and interest bearing bonds have a little bit more volatility than some of the previous sectors that we mentioned. So dividend stocks, of course, can reside in those sectors, but there is a little more volatility to those. So the stock price may go up and down a little bit more than some people are comfortable with. And the same may be true with bond values, especially at a time where the Fed is prone to change interest rates, on a year-to-year basis that can really impact bonds. So I like them. You just need to be willing to hold them for a longer time period to withstand times like
I
this.
see. And then last, even during downturns or especially during downturns, keep investing. This is known as dollar cost averaging.
Yeah, and almost counterintuitive when you're
Yeah.
doing something called dollar cost averaging, you're actually hoping for correction environments. With dollar cost averaging, you're taking a fixed amount of money and dividing it over a fixed amount of time, and you're trying to invest pretty unemotionally during times like that. But when you experience corrections, 5, 10% downturns in the market, that's times where during dollar cost averaging, you may find buying opportunities and you may want to double or even triple down if the correction's been big enough. So dollar cost averaging and spreading those purchases out helps you decrease the risk of buying everything at a high, but it also allows you to buy a little bit more when things have gone down in value, like we've seen over the past month.
And this all comes back to what you say all the time, Nolan, and what you've mentioned already, which is when we have a plan, we don't react emotionally to these headlines.
Yeah, and emotional investing is what makes people lose money a lot of times, selling when things have gotten bad or selling before things can get good. We just encourage people to stay calm, try not to time the market because you do have to get it right on the way out and the way back in.
Right.
Avoid panic selling. So during times of sell off, like what we've experienced over the past couple of weeks, not doing too much of it. And then just staying the course. That's why we develop plans. That's why we develop insulated portfolios that don't feel too much of what's going on right now, because you do need to rely on this money for a long time period.
Mhm. Yeah, and you've built this volatility into the plan already. If somebody wants to come to